The following financial statements and additional information are reported. Prepare a statement of cash flows for the year ended June 30th using the indirect method. The statement of cash flows includes three sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. The operating activities section includes cash flow from the day-to-day operations of the business. We find most of this information on the income statement. Using the indirect method, we begin with net income, $84,000, and then we make adjustments to reconcile net income to operating cash flow. We begin with a review of the income statement, identifying any non-cash revenues or expenses. A good way to identify these items is to remember that these items also affect long-term accounts. Depreciation expense is a non-cash expenditure. We add the amount of depreciation expense as a reconciling item. Gain on sale of equipment does not provide cash beyond the amount reported in the investing activities section. Gain on sale is added on the income statement, but we subtract it as an adjustment to reconcile net income. Next, we turn our attention to the balance sheet. The change in each account on the balance sheet must be fully explained before we can say we've finished the statement of cash flows. We begin with the change in non-cash current assets and current liabilities. We adjust for the change in current assets in the opposite direction, adding in the amount of any decreases and subtracting the amount of any increases. Accounts receivable increased. We subtract the amount of the increase, $18,100. The balance in inventory decreased. We add the amount of the decrease, $29,700. Prepaid expenses also decreased. We add the amount of the decrease, $1,900. The change in the current operating liabilities are adjusted in the same direction. We add any increases and subtract the decreases. Accounts payable decreased in the current year. We subtract the amount of the decrease, $6,200. Wages payable and income taxes payable also decreased. We subtract the amount of the decreases. Total adjustments of $51,500 are added to net income to calculate net cash provided by operating activities, $135,500. We've now fully explained the change in all current assets and current liabilities. Cash flows as a result of the purchase or sale of long-term assets are included in the investing activities section. In the additional information, we're told that new equipment is acquired for $60,100 cash. This is listed as a cash outflow in the investing activities section. We're also told that we received cash for the sale of equipment that had cost $48,800, yielding a $2,400 gain. This information does not directly tell us how much cash was received from the sale of equipment, but we can use the change in the balance sheet accounts to back into the amount of the cash receipt. The balance in the equipment account at the beginning of the year was $115,000. We know that we purchased $60,100 of equipment and then sold equipment that had a cost of $48,800. $115,000 plus $60,100 minus $48,800 explains the ending balance of $126,300. The balance in accumulated depreciation at the beginning of the year was $10,700. Depreciation expense is reported on the income statement was $57,800. Remember, the journal entry for depreciation is a debit to depreciation expense and a credit to accumulated depreciation. This brings the balance in accumulated depreciation up to $68,500. But we see on the balance sheet that the ending balance is only $28,600. Accumulated depreciation must have been decreased at the time the equipment was sold by $39,900. So if the cost of the equipment sold was $48,800 and it had been depreciated by $39,900, the book value of the equipment sold was the difference, $8,900. We sold the equipment at a gain of $2,400, which means we received more than the book value. The total cash received from the sale of equipment is $11,300. We post this amount as a cash flow from investing activities. Cash received from sale of equipment, $11,300. We've now fully explained the change in both the equipment account and the related accumulated depreciation. Net cash used by investing activities is $48,800. When you look at the balance sheet, the only accounts that have not yet been fully explained are long-term liabilities and/or stockholders' equity accounts. Cash receipts and payments related to long-term liabilities and stockholders' equity accounts are classified as financing activities. We're told in the additional information that a $25,000 note payable is retired at its $25,000 carrying value in exchange for cash. The change in notes payable is a decrease of $25,000. We record the cash paid to retire notes within the financing activities section. The balance in the common stock account increased. We must have issued additional shares of stock. Since the company does not report any paid-in capital in excess of par, the amount of the cash received from the stock issuance must have been equal to the change in the par value, $49,000. The only account remaining is retained earnings. We're told that the only changes affecting retained earnings are net income and cash dividends paid. The beginning balance in retained earnings, $7,900, plus net income of $84,000, is a subtotal of $91,900. Since the ending balance in retained earnings is only $24,900, the amount of cash paid for dividends must have been the difference, $67,000. Net cash used by financing activities is $43,000. The only account remaining is the cash account itself. The net increase in cash, according to the statement of cash flows, is $43,700. When we add this increase to the beginning balance of cash, $57,100, it agrees with the ending cash balance, $100,800. The statement of cash flows is complete. Compute the company's cash flow on total assets ratio for its current fiscal year. Cash flow on total assets is calculated by taking operating cash flows and dividing by average total assets. Net cash provided by operating activities is $135,500. We divide by average total assets, beginning assets plus ending assets divided by 2. $135,500 divided by $326,800 is a ratio of 41.5%. Each $1 of assets, on average, contributes 41.5 cents to operating cash flows.